Emotional biases are psychological tendencies that can influence our behavior and judgment when we make investment decisions. They can cause us to act impulsively, irrationally, or emotionally, often leading to suboptimal outcomes and lower returns. In this section, we will discuss some of the common emotional biases that investors face and how to identify and avoid them. One of the most prevalent emotional biases is loss aversion bias. This is the tendency to prefer avoiding losses over acquiring equivalent gains. For example, if you have a stock that has dropped in value, you may be reluctant to sell it because you don't want to realize the loss. You may hope that the stock will recover and you will break even. However, this may prevent you from cutting your losses and reallocating your capital to more profitable opportunities. To overcome loss aversion bias, you need to focus on the opportunity cost of holding on to a losing investment and have a predefined exit strategy for each position. Another common emotional bias is self-attribution bias. This is the tendency to attribute positive outcomes to your own skill and negative outcomes to external factors. For example, if you make a profitable trade, you may think that you are a smart investor who made a good decision. But if you make a losing trade, you may blame it on bad luck or market manipulation. This can lead to overconfidence and complacency, as well as a failure to learn from your mistakes. To overcome self-attribution bias, you need to be humble and realistic about your abilities and performance. You also need to review your trades objectively and analyze both your successes and failures. A third emotional bias that can affect investors is endowment bias. This is the tendency to value something more simply because you own it. For example, if you have a stock that you bought at a low price and it has appreciated significantly, you may feel attached to it and reluctant to sell it. You may think that it is worth more than its current market price and that selling it would be giving up something valuable. However, this can prevent you from taking profits and diversifying your portfolio. To overcome endowment bias, you need to remember that the value of an investment is determined by its future cash flows and not by your personal feelings. You also need to have a clear target price for each position and stick to it. These are just some of the emotional biases that can affect your investment decisions. There are many others, such as confirmation bias, gambler's fallacy, herd mentality, and regret aversion. The key to identifying and avoiding them is to be aware of your own emotions and how they can influence your thinking. You also need to have a disciplined and systematic approach to investing that is based on sound principles and evidence rather than emotions and opinions. One of the most important strategies to flourish in the stock market when investors are nervous is to diversify your portfolio and manage risk in volatile markets. Diversification means spreading your investments across different asset classes, such as stocks, bonds, commodities, real estate, and cash. By doing this, you can reduce the impact of any single market event or sector downturn on your overall portfolio performance. Diversification also helps you take advantage of opportunities in different markets and benefit from their long-term growth potential. Managing risk in volatile markets means adjusting your portfolio according to your risk tolerance, investment goals, and market conditions. You can use various tools and techniques to manage risk, such as asset allocation, rebalancing, hedging, stop-loss orders, and dollar-cost averaging. Asset allocation is the process of deciding how much of your portfolio to invest in each asset class based on your risk-return profile. Rebalancing is the process of periodically adjusting your portfolio to maintain your desired asset allocation. Hedging is the process of using derivatives or other instruments to protect your portfolio from adverse price movements. Stop-loss orders are instructions to sell a security when it reaches a certain price level to limit your losses. Dollar-cost averaging is the process of investing a fixed amount of money at regular intervals regardless of the market price to reduce the impact of market fluctuations. By diversifying your portfolio and managing risk in volatile markets, you can increase your chances of flourishing in the stock market when investors are nervous. You can also improve your confidence and peace of mind as an investor and avoid making emotional or impulsive decisions that could harm your long-term returns. In this section, we will talk about how to find and evaluate opportunities in undervalued or overlooked sectors or companies. Undervalued stocks are stocks that trade below their assumed value. They often have a track record of being profitable and the potential for long-term growth, but the stock market hasn't recognized that yet. Overlooked sectors or companies are those that are not getting enough attention from investors or analysts, but have strong fundamentals or growth prospects. So how can you find these hidden gems in the stock market? Here are some tips and strategies that you can use. One way to find undervalued stocks is by looking at a stock's price-to-earnings ratio, also known as P/E ratio. The P/E ratio is calculated by dividing the company's stock price by its earnings per share. To find the earnings per share of a company, divide its earnings from the past 12 months by the number of shares issued and held by stockholders. A low P/E ratio means that the stock is cheap relative to its earnings, and may indicate that it is undervalued. However, you should also compare the P/E ratio of a stock to its industry average or its historical range, as different sectors may have different valuation norms. Another option is to target undervalued sectors. You could look at specific sectors of the market that are trading below their fair values, according to Morningstar's metrics. For example, as of April 2023, communication services and real estate were the most undervalued sectors, trading 30% and 22% below their fair values, respectively. You could then look for individual stocks within those sectors that have strong competitive advantages, such as a wide or narrow economic moat rating from Morningstar. A third method is to do your own research. You could look for stocks that have positive catalysts for growth, such as new products, innovations, expansions, acquisitions, partnerships, or regulatory approvals. You could also look for stocks that have strong balance sheets, good cash flows, high returns on equity, or low debt levels. You could use financial websites or tools like scans to screen for these criteria. Additionally, you could read company reports, news articles, analyst opinions, or customer reviews to get more insights into the company's performance and outlook. A fourth strategy is to explore emerging industries. You could look for stocks that are involved in new or disruptive technologies, such as biotechnology, renewable energy, artificial intelligence, or blockchain. These industries may have high growth potential and offer opportunities for innovation and differentiation. However, they may also have higher risks and uncertainties, such as regulatory hurdles, competition, or technical challenges. Therefore, you should do your due diligence and diversify your portfolio when investing in these sectors. Finding undervalued or overlooked stocks is not easy, but it can be rewarding if you do it right. By using these tips and strategies, you can identify potential opportunities in the stock market that others may miss. However, you should also be aware of the limitations and pitfalls of these methods. Sometimes, stocks are undervalued for a good reason, such as poor management, declining demand, legal issues, or environmental concerns. Therefore, you should always do your own analysis and research before investing in any stock.